Okay. Um, Iran has not involvement in the attack. Israel and US have both said that they do not have any hard evidence of direct Iranian role in the attack. While sanctions have constrained Iranian oil output in recent years, the nation remains an oil producer and asserts control over the passage of tankers through the Strait of Hormuz, a trading route that facilitates the transport of about 15% of global oil supply. It's a big choke point. In the worst case scenario, if you were to cut off all of the oil coming out of the Strait of Hormuz, it would be a massive shock. An expansion of the conflict beyond Israel and the Gaza Strip will push crude oil prices higher, but gas prices will not necessarily follow suit. Patrick D. Hunt, the head of petroleum analysis at Gazprom, told ABC News. The seasonal shift from a busy summer travel to relatively quiet fall months has caught demand for gasoline, though Hunt said. In the event of a prolonged rise in oil prices, the drop-off in the demand for gasoline could help prevent prices at the pump from rising, Duhon said. While crude oil prices play a big role in what we pay at the pump, those seasonal factors disrupt what we pay for gasoline. A prolonged environment of elevated oil prices, though, would eventually push gas prices higher, Duhon added. It would require some extraordinary, he said. Beyond gasoline, a large swath of products could see prices increases if oil costs ripple through the production and transport of goods, leading companies to pass along those added expenses to consumers. Inflation has fallen significantly from a peak last summer, but it remains more than a percentage point above normal levels. A surge in oil prices will complicate the Federal Reserve's efforts to reduce inflation while averting recession, an outcome known as soft landing. So at this point, Gaza war, um, nobody's certain about its impact on. Uh, Nobody's certain about uh, how the war in Gaza Strip would have impact on global market. Okay, let's get back to this one. Okay. Occidental Petroleum. The consumer staple ETF has nearly doubled the yield of the S&P 500. There are many dividend kings with impressive payout histories in ETF. This could be a better long-term investment than risk-free treasury notes. The consumer staple sector is a unique source of passive income because it has a relatively high yield of 2.8%. It tends to outperform the broader market during a bear market recession. It also has a bit of growth. Okay, let's read this one. A $2 trillion stash you want to buy in October like they're going out of style. America is home to five companies worth $1 trillion or more. They all operate in the tech sector. Alphabet and Amazon both experienced a slowdown in growth last year on the back of macroeconomic challenges. But the worst might be behind them now, which creates a great opportunity for investors. Both Alphabet and Amazon will push for a further acceleration in revenue. The technology industry has created more value for investors than any other in U.S. history. All five American companies with valuations topping $1 trillion operate in the tech sector. Hmm. Um, I'm done talking about Israel Hamas war at this point. I'm now more focused on individual companies, more like uh, the companies. Okay, let's keep on talking about the article. Okay, but the worst might be behind them now, which creates a great opportunity for investors. I love you. I love you. Okay. Both Alphabet and Amazon will push for a further acceleration in revenue. I love you. Okay. Let's keep on talking. Okay. Okay. Let's focus. Mm. Okay. Let's pull myself together. Okay. Both Alphabet and Amazon look push for a further acceleration in revenue. The technology industry has created more value for investors than any other in U.S. history. All five American companies with valuations topping $1 trillion operate in the tech sector. While many tech sectors have had an impressive 2023 so far, the broader stock market, including many tech stocks, experienced a partial pullback since the beginning of August. The drop was related to a seasonal weakness along with persistently high interest rate that threatened to slow the economy. The pullback gives investors a rare opportunity to buy some of America's tech giants at a bit of a discount. Later this month, Google parent Alphabet and e-commerce giant Amazon will report their financial results for the third quarter. Okay, later this month. Okay, so at the end of this month. Okay, they will report their financial results for the third quarter. Okay, Amazon and Alphabet, both of them. Both companies reported accelerated revenue growth in the prior quarter, and investors are wondering if they could report more of the same in the third quarter. Here's why now might be a great time to buy a stake in both companies ahead of their results, especially given their discounted stock prices. Okay. In 2023, Alphabet finds itself in an escalated battle over artificial intelligence with rival Microsoft. The latter company bought a $10 billion stake in ChatGPT developer OpenAI in January and integrated into its Bing search engine, which threatened to upend Google's dominant position as a window to the internet. Investors were initially nervous about Alphabet's response, but it has made strides in AI in recent months. The challenge for Microsoft came at a bad time for Alphabet because it was coming off sluggish full year 2022 revenue growth of just 10%, down from a 41% growth in the prior year. A challenging economy over the last 18 months led business to spend less on advertising, which hurt Alphabet-owned platforms like Google Search and YouTube because they rely almost entirely on ad dollars. Okay. That weakness carried into 2023 with first quarter revenue growing by just 3% year over year. However, Alphabet finally saw a re-acceleration in growth to 7% in the second quarter, led by three things: more advertising dollars flowing into Google Search, a return to growth for YouTube, an impressive 28% increase in Google Cloud revenue. Wall Street estimates suggest the company will report to growth of almost 10% in the third quarter, which would make a further acceleration. Circling back to Alphabet's AI efforts, it might be the key reason to own its stock. The company released a chatbot to rival ChatGPT, and it has integrated additional AI into traditional Google search experience. Now, when a user enters a query, Google often places a text-based answer at top of the page rather than forcing the user to shift through web results. Alphabet highlighted the substantial progress it's making on AI for Google Cloud during its second quarter conference call with investors. The platform has now attracted more than 70% of the generative AI startups with valuations of at least $1 billion, thanks to its diverse portfolio of supercomputer hardware. Google Cloud customers can access and build upon 80 different AI models, and management said it saw a 15-fold increase and the number of developers adopting them between April and June. With Alphabet stock still trading down 7.6% from its all time high, it trades at a price earnings ratio of just 29.1, which is discounted to the 29.7 PE of the Nasdaq 100 index. It makes Alphabet one of the cheapest trillion-dollar tech giants by the metrics, so now might be a great time to buy ahead of what could be further progress in AI in its upcoming third quarter reports. Okay, so basically, the author in this article says that it's relatively cheap compared to uh, Nasdaq 100 index, because PE ratio of uh, Google is about 29.1, which is discounted to the 29.7 PE ratio of Nasdaq 100 index. Uh, what difference is not so much, but he says that it's like one of the cheapest trillion-dollar tech giants by that metric. I don't know what metric he's referring to, but from his standpoint of view, it's the cheapest one. Okay. And at the end of this month, we'll have reports, right? Earnings report or whatever. Yep, there it is. We'll report their financial results for the third quarter, and before that financial results comes out, it'd be better if you buy it in advance because it's cheap. Yeah, that's what it is. Okay, let's go to Amazon and see what that says. Okay, while Amazon built its business on e-commerce, its ascent to $1 trillion valuation came from a relentless focus on innovation and expansion. The company is now the leader in cloud computing through its Amazon Web Services platform. Has built a successful streaming business for television and movie content plus music. Like Alphabet, Amazon's 2022 revenue growth came in light, just 9% after increasing by 22% in 2021. E-commerce still the company's largest driver of revenue. It's extremely sensitive to change in consumer spending. AWS revenue has all slowed as the business focused on optimizing their digital infrastructure rather than investing more money in expanding it. But Amazon did see an acceleration in overall revenue growth to 11% year over year in the second quarter. Online sales grew 5%, the fastest since the final quarter of 2022. And while AWS revenue growth did slow to 12% year over year, the number was above Wall Street's expectations. Amazon is now focusing heavily on AI. The company is fresh off a $4 billion investment in AI startup and Anthropic, which has created a chatbot with a focus on safety and responsible development. But more broadly, AWS is protecting its position as the world's largest cloud platform by rapidly building its portfolio of AI hardware and software products. It has developed two AI chips called Inferentia and Tranium, and it has a set of in-house large language models called Titan, which AWS customers can build upon. Anthropic will train its future AI models on Amazon's chip under their new partnership, which is a huge vote of confidence from the startup. It could help attract more AI developers to the trillion-dollar giant's hardware, especially if they want an alternative to NVIDIA's chips, which are available at almost every cloud provider. Amazon will likely highlight further progress on its AI initiatives in its third quarter report later this month. According to the high end of its guidance, the company could deliver $143 billion in total revenue, which will be a 13% growth year over year. They will mark an even further acceleration. Amazon stock trades 31% below its all-time. And so now might be a great chance to buy since the company appears to be back on the upswing. Mm, okay. Okay, here's an interesting article. Here it says the Magnificent Seven stocks to avoid in October, and here it says Tesla. Let's see why. Okay. Hmm. Although the Magnificent Seven have held true to their name through the first 9 months and change of 2023, the future for at least one component looks anything but magnificent. In October, the one Magnificent Seven stocks to avoid is electric vehicle maker Tesla. Tesla's $827 billion market cap is a reflection of its leading role in the EV industry. It's the first auto company in well over a half century to have built itself from the ground up to mass production. The company is aiming to produce 1.8 million EVs this year and has the capacity to eventually top 2 million EVs. Combine its four existing gigafactories. It's noted it's also the only pure play EV maker that's generating a recurring GAAP profit. Tesla has reported a full year GAAP profit in each of the past 3 years. It looks to be well on its way to making it the fourth consecutive year in 2023. Unfortunately, everything from the company's pricing strategy to its leadership are reasons to steer clear. One of the prevailing Tesla uh, but bold investment thesis is that the company's production efficiencies should allow it to undercut its competitors on price. When Tesla kicked off a price war with other EV producers at the beginning of the year, so investors speculated that it could be the company's production efficiencies coming to fruition. However, CEO Elon Musk noted during the company's annual shareholder meeting that his company's pricing strategy is dictated by demand, with Tesla reducing the price of its four production models on more than half dozen occasions in 2023. It signals the inventory levels remain stubbornly high and demand for its EVs is declining. Tesla's aggressive price cuts have nearly halved its operating margin in a 9 month stretch. To build on this point, competition is only becoming fiercer in the EV space. Tesla lacks the branding power of legacy automakers, some of which have more than 100 years of history and customer engagement they can lean on. Another reason for concern is Elon Musk, who may be more of a liability than benefit for North America's leading EV company. While optimists strongly support Musk and his innovations, it's difficult to ignore that Musk has on numerous occasions drawn the ire of securities regulators. Musk also regularly promises the rollout of new innovations and products, only to have those dates kicked further down the line. Tesla's valuation is bloated by Musk's unfulfilled promises. Finally, there is a Tesla valuation, which makes no sense for an automaker. While Tesla enthusiasts will point to the company's numerous auxiliary operating segments as a justification for the company's aggressive earnings premium, I argue that Tesla has struggled to become anything more than an auto stock. Energy storage revenue actually fell in the June ending quarter from the sequential first quarter, while solar business has been losing money since day one. Tesla's profitability is almost entirely dependent on selling and leasing EVs, whereas most auto stocks trade at a mid to high single-digit price earnings ratio. Tesla is commanding a multiple of 78 times forecast earnings this year. It makes no sense for a company in a highly cyclical industry. So, while a lot of people are positive, this guy is negative. When looking at Tesla, the point he makes is that Elon Musk himself is a guy uh, with unfulfilled promises. He says something and he doesn't keep promises, and it's repeating. So it's more of a like doubt uh, about his personality and Tesla's evaluation. Uh, he keeps pointing out that it doesn't make sense for an automaker. Of course, Tesla, they do a lot of businesses at the same time. They have like supercharger network, energy storage, and other sectors. But what's important is that they don't make profits. The only profits uh, coming from Tesla is EV models that they sell and make people borrow. And mm. and what else did he make? The and yeah, well, here competition is becoming fiercer in the EV space. A lot more EV makers coming in, and the competition is going to get worse. And that's all the points that he makes, but it doesn't really mm. Anyway, move on. Applied materials, super microcomputer. Cisco Avi. Okay, I'm done reading articles, but last but not least, I'll read one more article and then I'll put an end to it. Okay. Mm, let's see. Roku. Okay, Roku. Okay, Kathy Wood goes bargain hunting. 3 stocks she just bought. Mm, okay, let's read this one. Her large ETF is now trading lower than where it was at the end of January. She's not sitting still. Wood continues to make moves, letting investors know what she's buying and selling at the end of every trading day. What is she buying now? Wood added to her stakes in Roku, blog, and utility Unity software on Wednesday. What does Wood see in these three growth stocks? Are trading well below their previous highs. Okay. Starting lines matter in sizing up the success of Roku investors. Shares of the leading operating system for streaming service through smart TVs are up 72% this year, but their stock chart less than flattering. This is the first of the three stocks we're looking at that's currently trading 86% below its 2021 all-time peak. Roku is keeping viewers entertained. It has 73.5 million accounts on its platform at the end of June, 16% more than it was serving a year earlier. Usage is up 21%. It's encouraging to see it growing faster than the active user account, but platform revenue rose just 11% in its last quarter. The weak ad market for connected TVs weighing on its upside. This is still the third consecutive quarter of better than expected revenue growth for Roku. Roku updated its third quarter guidance in early September and now sees 835 million to 875 million for the quarter that ended last week, up from 850 million it was targeting in late July. Also now sees a smaller adjusted loss as measured by earnings before interest, taxes, depreciation, amortization that it was originally forecasting. The midpoint of its new guidance calls for 12% year-over-year growth on the top line. It might not seem like a lot, but it will be Roku's third consecutive quarter of accelerating revenue gains. The bottom line has been more problematic, but recent layoffs or code control should help turn its lack of profitability around sooner rather than later. Okay, anyway, this is it for today. Done reading, and I'll see you tomorrow. Okay. Yuni, bye bye. Bye bye. Bye bye.